Hello and welcome to your Monday Futures Market Outlook for March 12, 2012. This is Patrick Stresna. If you'd like to try out a membership to our eminisource.com trading room, please visit the website for details. As always, we start off with a chart of the US dollar index futures, and we basically have a US dollar that continues to strengthen and attempt to break out here on the upside. This is going to be a crucial moment as more than likely we're going to attempt to break this 80 level on the upside here. If there could be some short-term follow-through back to the highs of January around that 81.50, 82 level. If there is, even if we initially rejected off this 80 level, it's likely that a retest along that 78, 78.50 support line will act like support and not break down, setting up for a bigger picture kind of move. We still anticipate that the US dollar should strengthen into the second quarter of the year, and we could see at some point this summer even highs up in the 84 to 85 level on the upside. Next year, we're going to take a look at the Euro FX futures. We also see the inverse chart of the US dollar there as it's attempting to break down. We continue to see this rising wedge and a potential break lower. We're going to find out shortly whether or not that break has any real follow through. There could be some initial supports around the 130 level. But at some juncture, we do whether there's still another double top retest up along these previous highs or not. We anticipate there to be another round of euro weakness at some point in the second quarter of the year. Next, we want to take a look at the 30-year Treasury bonds, and we've now more or less again consolidated down along the 140 to 141 level. We've been trying to look for a breakdown in these Treasuries to even potentially test that 134 to 135 level on the downside. In the much bigger picture, we're actually bullish these Treasury bonds, but on the short term are looking still yet for further consolidation in the next couple of months. So let's see what happens at the support line. Any legitimate break of 140 on the downside should bring in some more aggressive selling, but that support line is pretty substantial. It has reversed this market continuously over the last 4 months. So let's first see whether or not again we have another bounce off of the support line. Next year, we're going to take a look at copper futures. We have a double top along the upside, and there was a nice breakdown last week. What will be very interesting to see right now is whether or not copper fails to rally back up to those previous highs. There's nothing that puts the nails in the coffin of a rally than a failed attempt to break out. And so with us having spent the early part of last week, or the latter part of last week, rallying back up, if we see any reversals of copper off this level, particularly if we break that 370 level where the lows have come in the last two sell-offs, that would open the window for some more aggressive selling. Next year, I want to take a look at the crude oil futures, and crude oil is a very tricky chart right here. Not only is there a substantial geopolitical overhang along this, but really at this stage we still see flagging formations that could result in a bullish breakout on the upside. That could see us even test the 115, 116 level if there was a bullish push. But in the same regard, any failed rallies here along the way could first still have a solid retest of that 101 to 103 level on the downside before there's any bigger reversals. So we're far more kind of neutral, letting crude oil finish out chopping around here before we see whether or not it has the conviction for still yet another breakout. Next year, we're going to take a look at gold futures. We've been identifying that rising wedge that retested the 1800 level right on the upside. We've now seen numerous attempts to sell off and rally back up, but yet the gold bulls have yet to muster up anything of any substance. At this stage, we are relatively neutral to slightly negative gold, and at this stage we're not of the belief that gold will go through a very substantial crash in this cycle, but at this stage we also believe that there's limited upside, and that should all be capped to the 1800 level. So any rallies at this point in gold are probably going to develop as shorting opportunities for moves that could at some point in the second quarter retest the 1550 level where the lows came in back in December. That brings us to wanting to take a look at the S&P 500. As always, we start with a weekly chart and we plot an 80-week moving average on there to depict those bull and bear market cycles we've gone through. Over the last year, we had numerous false signals along the way as there was very much indecision as to whether or not the primary trend would be down or up. But we are now trading decisively above that 80-week moving average with it trending higher. Right now we are in an uptrend, and we may very well even in the upcoming months remain in an uptrend beyond little short-term pullbacks, and then we'll be looking for a bigger picture turnaround at some later point. When we zoom in on that and look at it on a daily chart, we've been looking for inevitably a market correction that would last anywhere from 5 to 10 days on the downwards. We had a very quick aggressive sell-off early last week, but it almost immediately was bought. But really at this stage there is room for what we retests of the previous highs and other things like that. So we initially don't trust this rally, particularly because the duration of the sell-off and the depth of the sell-off was not deep enough. So we were initially not trusting this rally and still think there's another good round of selling that could come in. We are not bearish this market. We simply are looking for a consolidation point from which we could actually be buying into what still yet would be potentially a bullish April and May month in the stock market. So by no means are we trying to bear monger here, but rather we're just simply looking for a consolidation that is deep enough for us to buy. When we take a look at our key intermarket observations, we've really now switched to almost a neutral stance on the short term on all of it, including the bonds. Really, in the bigger picture, we actually believe the longer term that the US dollar could be bullish, but was working out this kind of consolidation point. Similarly, on commodities, we haven't really seen a real breakdown in commodities. We are going to be relatively bearish those commodities in the second half of the year if our bullish US dollar thesis materializes. But again, right here, we don't believe that they necessarily have to aggressively break down from this exact level where they're at. In the same regards, we think that bonds can be very good in the longer term. But on the short term, we're going to really kind of take a more neutral stance. We're right at the bottom of the support line. There definitely is room for there to be another even 3-4 handles lower on the 30-year Treasury bond, but that would probably emerge as a buying opportunity on those bonds. On the stock market, we are hesitant to want to put our longer term stance to being bearish, but we on the short term we're going to stay neutral to slightly bullish on the stock market. But at some stage, as the market reaches higher levels into April and May, we may take our longer term stance to a more bearish stance on the stock market. But right now, we don't want to mislead anyone and are going to leave it at neutral just to kind of emphasize the fact that we still think that the stock market has room to still advance. That was your Monday Futures Market Outlook. Thank you for joining me.